Greetings, members one and all of the Salivation Nation. Analysts say it is a good opportunity to buy gold and silver now. Let's explore. Yes, that's right. And it should be no surprise that some of these analysts, well, they have interest in the precious metals. Either they sell it or are heavily invested in them. So take this for a grain of salt. But I think there's usually something we can take out of this. But whenever any kind of advice like this goes out, number one, you should consider the source. But number two, you should also consider your personal situation. Because really that is what it boils down to, is whether or not you feel like you have enough or you feel like you should get some more. But make no mistake, you are taking a risk that the price could go back down, but you should also make no mistake in that you're always protected by the intrinsic value of the metal contained therein. Because if the price does go down, typically that means the economy is doing better, and more likely you will be doing better as well financially. In theory, it's not always the case, but those are the risk rewards that you take, especially when you're buying an asset that is a hedge, such as gold and silver. Before I continue, I want to encourage you to take a look at the like button below this video. It's there. I'm not telling you necessarily to press it per se, but I just want to point it out to you that it is there. So let's get into this. Amidst the sharp equity sell-off of late, the precious metal market has quietened down a bit, not able to raise media and investor interest like it once managed to back in July and early August, really even before that. This was certainly not a long time back, but it is an age in the financial markets for sure. It seems like everything that happened so quickly, especially with this situation we're dealing with now with the economy in this article here from Seeking Alpha. As they say, the market has a short-term memory, and it's easy to have one's attention drawn to something that is moving, like the meltdown in equities, and lose sight of something that was once glittering but now has flatlined. Now, however, is an opportune time to buy into gold and silver. Since mid-August, gold and silver in the ETFs have been stuck in a very boring trading ranges that have been getting increasingly narrow. If you look at the chart of gold below, notice it's increasingly confined trading range. Swing highs are increasingly lower and swing lows are increasingly higher. Volume has been steadily declining too after gold hit record highs. And I would argue that's a good thing. That's showing that gold is stabilizing because it's not really supposed to be a wild, volatile asset. The story is the same for silver. If the chart below, you can observe the same contraction in trading range and volume. I would also say that's a good thing. Even though the gold to silver ratio has not narrowed like we like it to see, nonetheless, it is narrower than it was before. It was up to over 100 to 1. But we're kind of back in the range where we saw it before all of this madness happened in March. You want to talk about March madness with the coronavirus? That is the time when it had occurred. If no one is interested in gold and silver anymore, we should just abandon trading it, right? Ironically, this is the best time to venture into these markets and build long positions. But I will caution you that gold, and especially gold, is moved into a level that has broken the previous nominal price and so some think that it may be overpriced. Now, I don't know that I'm necessarily in that camp. I'm sort of at odds, but with the gold to silver ratio being where it is, and that we're still above those highs, I'm wondering if we could see a major correction in gold. But I don't know. No one really knows, and that is the key takeaway from a position like this that the author is taking. So we must establish if gold and silver are on uptrends or not. If not, we should definitely not be looking to build long positions in these markets, which is the obvious statement of the day here. There are two levels of interest that the author has drawn in the chart below. First, gold rallied out of its 2013-2019 base in the middle of last year, and this breakout places it on an uptrend. Second, gold is now stalling and consolidating at its previous all-time high. It is normal to see this level exhibiting a high degree of stickiness, but once the market is done consolidating, it will be ready to continue its uptrend. And we can see it. More of a laggard, silver broke out to its base early only this year and is on an uptrend. Prices are taking a breather after a sharp run-up this year, which is fully normal. What makes silver more exciting than gold is that if the precious metal rally continues, it has far more ground to eat up on its way to its record high in 2011. That's right, and it's definitely has a long way to go there. Here we can see silver's comparison to gold there. For traders who missed the rallies in gold and silver, the period of consolidation both are going through now is a gift. This presents an opportunity to build or add to long positions to potentially catch the next leg up in the uptrend. Uptrends can fail, of course, and that is the caveat here, but now is a more opportune time to take on risk as a period of consolidation allows us to more effectively size up the risk-reward dynamic. You know you should exit the position if gold or silver breaks out lower from the trading range drawn in the charts above. Hence, you do not have to pay a lot to find out why you are wrong. On the flip side, if you go long amidst a rip-roaring rally, where can you reasonably place your stop loss to protect your capital? An upcoming catalyst is the U.S. Central Bank meeting this week. In fact, I think that might be tomorrow for the two-day meeting to start. The Federal Reserve has pulled all stops to assure the financial markets that interest rates will remain low for the foreseeable future. We can pretty much bet on that. And markets, I think, have already baked that in. And we can expect more of the same this week. Consider also that sentiment in equity markets has been fragile as of late. It is probably not the best interest for the Fed to sound overly hawkish now. Since the great financial crisis, low interest rates, Fed funds effective rate in blue, has generally provided a support backdrop for gold and silver prices in orange and pink respectively. You may observe how precious metal prices respond to a period where interest rates fall dramatically, shaded in green, and in periods where rates rise dramatically, stated in red. And then we can see it here. And see what this actually shows us here. Where these metals, pink and red, I guess that's silver price there. 27.45, and we can see where the interest rates have gone up. Well, they've kind of flattened out. Silver's actually gone down a little bit. Gold has kind of remained relatively flat. Little dips and the like here and there, but when interest rates go low, the metals have gone up. And then they, I guess towards the end of it, then they've gone back down here, as we can see here. Interesting indeed. Going back to the 70s, you may also observe below that low interest rates have been a damper on the U.S. dollar. Periods where interest rates fell dramatically are shaded in red, which coincided with the weak greenback. All right, there we go. You can see it there. Fascinating. In summary, gold and silver have been in consolidation phase after enjoying immense rallies in July and August. The timing is ripe to enter or add to long gold and silver positions, and the Fed meeting this week could supply the catalyst for gold and silver prices to restart their engines. And I think, in a sense, we're kind of seeing it with gold. It's kind of made a move, and it's kind of, even today, it's kind of, we'll look at the prices here momentarily, but gold is on a second day of kind of some gains here. So we'll see what happens. Now, here's another article here from Kitco, from Niels Christensen. Gold price should hold steady through 2023, and silver has more potential, especially when we look at considering the historic ratios during times of these increases. The Federal Reserve's new inflation target of an average of 2% has created even more long-term potential for the precious metal price and mining sector, according to one Canadian bank that is now raising its long-term forecast for gold and silver. In a report published last week, analysts at the Bank of Montreal announced that they were raising their long-term gold and silver price forecasts. The bank now sees gold prices averaging above $1,800 an ounce through 2023. I think that's a pretty safe bet. For this year, the bank sees gold prices averaging their fourth quarter around $1,920 an ounce, up 4% from the previous forecast. The bank is even more bullish on silver, as it now sees the prices for the precious metals averaging above $27.60 an ounce through 2023, up nearly 50% from their previous estimate. The analysts are more bullish on silver as the physical market pushes into deficit this year. At least that's according to where they're getting their information. We talked about that too. Are they lying about supply and demand? Looking at silver prices, the bank sees prices averaging the final quarter of the year around $27.50 an ounce, up 47% from the previous forecast. The bank added that although it has increased its medium-term outlook, its long-term outlook remains unchanged. Gold prices are expected to average $1,400 an ounce, and silver is expected to average around $18.25 an ounce. That's interesting. As we factor in a new Federal Reserve policy of average inflation targeting, as announced at the recent virtual Jackson Hole Economic Policy Symposium, the net result is likely to be low for even longer interest rates, the analyst said. With this, we see the precious positive cycle of macroeconomic policy being prolonged, and have thus increased our short to medium term gold and silver price forecast. Although BMO analysts are bullish gold and silver, they don't see runaway prices above $2,000 an ounce anytime soon. Interesting. Okay. They added that the best way to play the precious metals market is as prices hold around current levels as through money equities. They noted that because of higher gold and silver prices, they have increased their equity target prices by an average of 9%. In our view, the key story is gold is the rise of industry profitability, the analyst said. Looking at gold prices, the bank said that the market should remain at its current range, as it doesn't expect to see real bond yields pushing much further into negative territory, nor pushing into positive territory anytime soon. Unless we see further currency debasement, our real yields drop even further. The story from current levels is not about whether the gold prices rises a further 20%. Rather, it's about the duration of gold prices in excess of our long-term equilibrium, the analyst said in a report. Thus, the key factor to watch over the coming years is what the gold mining and refining industry will do with the strong free cash flow set to be generated. It's a lot of things to consider there. And so we look at here, we see the gold did make some gains earlier today. It's lost a little bit of its movement here, dropped back a little bit, but still up 1954.90. Unusual to see that drop of gold, and silver is actually up 0.13% to $27.24. Platinum, palladium, and rhodium are all up there. Rhodium's almost $14,000 right now. Palladium is up $106 with the biggest move of the day. Fascinating. And platinum is getting close to $975 an ounce. So there it is. Fascinating indeed. So it's a good opportunity to pick up gold and silver according to these analysts. And I would say that probably is too. But, you got to think about your situation, your personal situation, no matter where the prices go, if you can do it. And always remember the risks whenever you're purchasing. So there you have it. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate. Yes, now I'm asking you to go ahead and hit that button there, the like button, please. Comment, and finally, subscribe.